What's going on, guys? It's Josh. Today I'm going to make a video talking about the biggest mistake people make when trading options. Now, I usually see this with beginners, but it could happen to all sorts of people of experience level and depending on the strategy that they're employing. Now, if you guys like this video, make sure you subscribe, drop a like on the video, give me a comment, give me more questions that we could explore. I always have to say that because I do want to start, I want to see where you guys are at on this, see who I'm talking to, but this is something I think at any level it applies to almost every option trader, especially the beginners too. And the thing is, watching the break even price and how it comes into play. A lot of people think that it's just the price of the option they're playing. And I'm going to use an example here on the S&P but or the spy, and it goes back. I don't know when I'm going to drop this video. I might have already dropped it, but there's that trade I made on regen, and that one was at $20 into about $250 $300. And the reason why that one worked because the contract went up a lot, but I surpassed my break even price. And now this may seem obvious, but the thing to take into consideration is where people mess up on. It's how the option gets value over time, and as it comes closer to expiration, a lot of people wonder, well, why did I just lose money? Why did it just go down? And it's factoring in both the price you paid for that option and where the stock is at. But a lot of times it's this break even issue that people have trouble finding, and this is how I find cheap options, is by understanding, I'm saying, what is it going to take if I buy the option now at this price? For me to make money, it has to get to here. So especially when doing the short-term options, that's why I'm going to look at some weeklies here to kind of explain it. And you guys saw even in my last video, I talked about making those place markers, but essentially your break-even price is simply added to whatever you pay for the contract. It's harder to think on puts, but let's do it with calls. So let's say you think the market is going to go up, the SPY's at 275.42, you get a 276 call for 93 cents or 93 bucks. Now, this doesn't mean you make money if it goes to 276. Now, let's say it's a July 11th contract, July 9th rolls around Monday, it goes up to 276. The contract will probably go up in value. Now, how much is going to depend on the time decay, which you could even look at the theta, but even then, it's going to be the time decay and where the stock is at and how much it's moved. But, if there's 2 days left on the contract, it hits 276. Chances are the contract is going to go up. How much is going to depend on how much did the market move and how fast. Now, you guys probably hear Jackson in the background. He's trying to play. But putting this into context now, you're pretty much saying I need the stock to go. You're saying really the simple way to add it up, add 93 cents. You won't make money if come expiration the stock is not at 276.93. You will lose money. Even if the contract's worth 50 cents, it goes to 276.50, it's 50 cents in the money, you still paid 93 cents, you lost 40 cents. And that's where people mess up and they pay too much for the contract. So why I'm saying this is the biggest mistake, because a lot of people don't factor this in. And if you really get a grasp of this, you could start being able to finesse a lot of these contracts and do good, because you're able to say, hey, well, don't look at just the price of the contract. Oh, I think it's going to go up. And this is that strategy I was talking about where people mess up, is they're trying to trade the premium alone. They start trying to trade, okay, well, 276.93, I'll get it for 93 cents. The stock's going to go up. It'll go up 30-40%. I'm just going to sell it out. And then they hold one day, the stock doesn't move, it comes down. And really, as it comes closer to expiration, all these are going to come back. That's why come a day or two before expiration, if it's literally one or two spots out of the money, it'll be 30 or 40 cents, because you're making a pretty crazy bet that it's going to go up, X amount of percentage, by that expiration date. So that is the biggest mistake I see people make, and how you're going to look after that is making sure you're picking a contract that has a realistic time frame, in the sense of, or a realistic strike price based on your time frame, and then what you're paying. That's how implied volatility, if the market shoots up, those calls are going to get really expensive. So it's based upon the implication that the market's implying this trend will keep going at this pace, 1% a day, yada yada yada. If it doesn't, you could get screwed. So then you're usually going to be paying a lot to secure it. Market may go up, but you'll still lose on the contract. So how you could do better at this is by saying, picking a strike price that's realistic, that you think the stock will go to, adding your your strike price or adding what you're paying for it. So in this case, if you think the market is going to go to let's say 278 and you want to double your money, then this contract would be good. But now it's factoring you must have the stock at 277.50 just for you to break even, which means you will not make money. That means you will get all of your money back, no profit. So if you think it's going to go to 278 and you buy this contract at 52, you're making the explicit agreement and you're saying to the world, you're literally implying, yes, I think the market will go higher than 277.52. If you think it's going to go to 278, then by this guaranteed, you'll make 100% on this contract just by simply, doesn't matter what happens. Even if the same day this comes here, you win. That's what happened on my regen trade. I paid 40 cents for the contract and it was a 367 or 366.50 call. I just needed the stock to go past 367 and it went $2 in the money. Hence, $40 turned into $200 because it doesn't matter now. Implied volatility, extrinsic value, those are just going to add on to that. But with 1 day left, 2 day left, it doesn't matter. So again, understand these calls you're making when you go further out. And this is if you watch my video, how to make 100K in options. When you're going out for these longer term contracts, maybe we could look at like Amazon or something, factor this in, say, hey, where do I think it's going to go by this time? Do I think it could move 10, 20%? And you see these contracts are expensive. So if you want to start looking for these ones, they're still going to be pretty expensive. And this contract right here, 2220, you're saying Amazon is going to go up not only to this price, but $4 above that by expiration. And that's what you'll notice. This is how you could understand how options get pricing, because as the days tick and it gets closer to expiration, if that price isn't high or if the stock's not near that price, the premium is going to go down, because the likelihood of that happening and getting up to that price and then surpassing it to make profit decreases. And that's where sometimes you could snipe opportunities. But again, that's where it's risky, because they are priced like this for a reason. We go here to, maybe I should go back to the SPY. That's why the SPY contracts are so cheap when you could get to the Monday. And now even then, this Monday is still pretty expensive, but 6 cents for the market to move 3 points. But that's saying by the end of the day, Monday, the market is going to move up pretty much another 1/8 of a percent or a whole percentage point, which is that's a big move on a global market like this. But then again, it still can happen. Hence, high risk, high reward. So if you guys start trading options, you're already trading options, be careful of just buying contracts to buy the contracts and flip the premium. Is that a good strategy and can it work? Yes, but you have to understand how time premium is going to come into play, but ultimately your break even, what are you implying and what are you saying about the contract? If you pay too much for the contract, what's going to raise that premium price is what's going on with the market, how the asset has moved over time, and does the market does the market expect for it to continue, or has it fizzled off? That's why I go back to my option, buying during volatility. You find those days when, after it's moved up, it didn't continue the crazy up or down trend. And then after 2 or 3 days, those IVs will drop, the implied volatility, and then you could start to get things closer. Time premium is decayed a little bit, and now you could start to make a point. But at the end of the day, you are picking where the stock is needing to go. It doesn't matter if you get a good contract, and that's what a lot of people ask me. I am going to make a video on how I select the pricing and how I understand what's a good and what's a bad contract. It really is based on how I believe the asset is going to move, because you need to understand what is going to move and what's going to be likely when it moves. So if you can't get that part down, it doesn't matter. You're shit out of luck. You could get the best quote unquote price contract, but is it really a good price contract if the asset doesn't move? So hopefully you guys watch your break evens, always paper trade, get a hang of it, and start understanding the message you're making when you're buying this. When you buy a 276, you're saying it's going to go to 276.49. So always add that and factor in now how likely is it for it to go up a whole nother point, whole nother percentage, whatever it may be in that circumstance. So hopefully that, it's very simple, but hopefully you guys get this. This is the number one trade, the biggest mistake you could avoid. Simple. Keep it simple. A lot of people, you guys aren't making mistakes on selling premium, iron condors, trying to, interpret stuff crazy. The big mistakes with option is factoring this stuff in and not understanding, how is that going to affect the value of my contract next hour, next 30 minutes, next day, next week, next month, because option prices change every day. And that's why these deals are created. That's why option prices can go 10,000%, 1,000%. It's because they're moving all the time. So you need to understand what you're implying. And then also don't underestimate, it's not always about the contract, it is always about the underlying asset. So hopefully that helps you guys. Hopefully you learned something from it. If you did, leave me a subscription or comment, get me a sub, and also comment below if you don't get it or if you want me to elaborate on anything. Love you guys. Stay in school.